Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And after about a half hour of technical difficulties on my end, we are back. Episode 139, Carson's Facts versus Feelings. Bromance interrupted. You know where that's going. Yeah, I mean, I'm not sure. Like, I was talking to Sonu and Josh, our producer. We changed our whole basement around, and I used to hardline my laptop in, but that's on the other side of the basement, so I've got to get the Spectrum out here and get them to wire at a different spot. But I figured I could just use wireless, right? I've got fast wireless, and for some reason, we had a lot of trouble, but I restarted the old restart. You know, it's like, I forget, I had something the other day wasn't working. I can't remember what it was. I said, well, let's just restart.
Is it the toaster?
Don't even go on the toaster. You know, I think it took me 2 weeks, Sonu. I think I figured out how to work my AI high-tech toaster. I think I finally got there. But it's apparently internet is working just fine now. It's amazing when internet doesn't work, how things go. You had something, your kids, what'd you want to banter about here? I forget you had something.
Actually, no,
I wanted to say. What was it?
I was, I've been in the market for a car, and now turns out there may or may not be one free or available at 1600 Pennsylvania Avenue.
Yeah.
But from what you just told me, apparently it's no longer for sale, huh?
No, President Trump said on Monday he's keeping his red Tesla now. So that's why I said we came up with other titles. I like Bromance Interrupted. Call me. I don't know what you're going to call me. Call me what you're going to call me. I'm not buying it. I think they're going to be friends again someday. Yeah. We'll see. I don't know.
For some time there. Before it goes again.
Exactly. Before they blame each other for going to Epstein Island and everything else. You saw the headlines. You know where I'm going with it. All right. Let's dive into it, Sonu. This is episode 139, Bromance Interrupted. Let's talk a little bit about the feud that we have going on. And it's crazy to think 2 months ago was the lows, and we've had an incredible 2-month rally. Kind of talk about the market rally that we've seen. Then there's a lot of economic data, potentially slowing economy, jobs data, a lot of inflation data this week. Want to dive in there. So lots of places to start, but let me just read it because I thought it was funny. Yeah. Let me. Okay.
Are you going to do a voice?
I can't do a voice. I can't do a voice. I can't do a voice. But I'll just read. So I asked Grok to summarize the Trump-Elon Musk feud, but do it in the voice of a pirate. So here we go. Arr, matey. Last week, the seas of politics turned stormy as Captain Donald Trump and the swashbuckling billionaire Elon Musk clashed like two birds in a squall. 'Twas all over Trump's big, beautiful bill, a hefty tax and a spending plan that Musk called a disgusting abomination. For pilling on the nation's debt, the feud sparked on Tuesday when Musk, once a loyal mate to Trump, fired a broadside on X, blasting the bill and digging up old quotes from Trump himself, warning about big government spending. By Thursday, the cannons roared. Trump, feeling betrayed, threatened to scuttle Musk's government contract. We're halfway done. Worth billions. F-E-R, for his SpaceX and Tesla ventures. Musk, not one to back down, claimed Trump owed his election to him, and even tossed in a wild accusation about Trump being on the Epstein files, though he later scrubbed that post from X. The true traded barbs like cutlasses. What is even that? Cutlasses. Whatever that is.
Swords.
Swords. There we go. Thank you. Learn a new word every day. I'm not a real pirate. I just play one on a podcast. With Trump calling Musk, quote unquote, crazy, and Musk threatening to decommission his Dragon spacecraft, vital to NASA, afore walking it back. And a cooler head prevailed. The White House tried to douse the flame, saying Trump, let me move this down, we're almost done, I swear, saying Trump be focused on his bill, not the spat, whispers of Musk past drug use, and a scuffle with Treasury Secretary Scott, this is a busy week, Scott Bessent kept the crew a-gossiping. By week's end, the waters calmed a touch. Trump said he weren't been a parlaying with Musk, claiming their bond be sunk, while Musk's own father urge him to let the feud fizzle. Yet with Musk starting a new political party and Trump a warning, serious consequences if Musk backs, I didn't even know this one, if Musk backs the Democrats, this pirate brawl may see a more cannon of fire. There you go. All right. So anyway, so
I'm cracking up because this is the first pirate from Ohio.
I mean,
with a Midwestern accent.
It's funny. That was last week. I forgot half that stuff. Anyway.
So one thing I didn't know is the scuffle with Besson. So when you sent me this, I have no idea what that. So I Googled it. This was yesterday or whenever you sent it to me. I think it was yesterday, a day before. Right. And I Googled it. I was like, what? There was a physical fight near the Oval Office, outside the Oval Office between Elon Musk and Treasury Secretary Besson. I mean, if anyone's seen Besson in real, on TV, he doesn't look like the type of person who would get into one of these things. Musk, who knows, right? But I was like, wait, there was an actual physical thing between the two of us. Like, what is happening? But anyway, set that aside.
Yeah. Yes. So we've got. I don't even know where to take this. Anyway. So yeah, that all flared up, like we said. Last week it was brewing, but on Thursday we're all watching TV and just live. The bromance was in flames. They're going back and forth, and market was weak. I mean, Tesla dropped 14%. Obviously, on a market cap weighted basis, it was an enormous deal. And then
is that what we should look at, by the way, to see where the feud is? Look at Tesla's price. I mean, since that day, Tesla is down 14%. It's regained half of that, so we're halfway through the split. So
yeah, I think that's probably one way. That's one way to look at the feud. But again, the good news. Then we come back on Friday, and stocks came soaring back, which we'll talk about. Anything else you want to add on the feud before? No. I mean, I think reading it as a pirate might have summed it up to the best of our ability.
Not without getting into trouble, but
we'll leave it. We'll leave it there. But so anyway, so clearly it moves markets. I mean, we saw that on Thursday, right? The news, and I mean, you could argue that was one of the most fun days on X anyone's ever had. The memes and the back and forth, and apparently Truth Social, Trump's place, crashed because everybody's signing up for that to see how he would respond over there and waiting for how Musk would respond over here and all the anyway. So maybe it's all
actually last thing since June 3rd, when the feud began. June 5th was D-Day, I guess, or maybe T-Day, right? Tesla is down about, as you said, from June 3rd through the bottom on June 5th, it was down 17%.
Okay. Yeah.
It's down about 9% right now, 8 to 9% thereabouts. So again, not a recommendation to buy or sell Tesla shares, let alone Tesla cars, right? I guess, as you tell me, there's no longer one available. One less.
Probably a few more out there, but one less. But then I've playfully, and Josh, I didn't send this chart to you, but we can put this chart up now, and I'll get it to you in a second. The Rocky Balboa market. I know, Sonu, you're a fan of Rocky. I've got a blog.
My favorite movie.
I know. I've got a blog coming out, carsongroup.com/research. By the time you listen to this, you can check this out. But we'll share it on the YouTube channel now. When you have a down day in 2025, the next day is historically strong. Okay, so as of the time we're doing this, the next day is up 0.29%, 29 basis points. Okay, what's that mean? That's the second best month we've seen since 1980. Okay, I'm sorry, second best year. So this year is the Rocky Balboa market, where last Thursday, all the drama we just talked about with the bromance feud. The next day, you bounce back and close above 6,000 for the first time since February of 2021. And there's lots of ways to look at this, but if you listen to this very podcast, we've been saying for a while, we're probably in a bull market. We're going to likely make new highs, catching up with the rest of the world. It's already been doing it for a while. And this strength after a down day is, again, just another hallmark to me, Sonu, of a Rocky Balboa market. What do you want to add there?
Yo, Adrian, that's how.
There you go. That's what you added. There you go.
Now, I'm trying to think about, I was going to ask you the question. Why do you think that is? What type of market environments do we see, or things go down and then the market waves, sort of recovers almost immediately, as opposed to, because you always talk about the market takes is it the stairs up and the elevator down? Yeah. Now it looks like it's taking the elevator down and the elevator up.
Yeah, well, that's true.
Does that make sense?
Yeah, I'm gonna get this there, Josh. I just sent you that Rocky chart. That is the old saying, and I guess the reality is it happens in years that had early lows and rally, like previous years that we saw really strong strength the day after a big down day. was in 2003, 2009, 2020. Do those years ring a bell? They all bottomed early in the year in March. We bottomed early April this time. And yes, I get it because people point this out on social media, and I don't disagree. Hey, April 9th, right? We gained 9.5%. Well, we were down the day before. So you take that day out. Yeah, it's not as strong. I get it. We get it. And that's probably why a lot of those years are somewhat skewed because you have a big up day near the lows. But reality,
if you take that day out, you kind of have to take the previous day out.
Take Liberation Day out, right? Like take the 10% drop in lip. So yes, take it with a grain of salt. But at the same time, you tend to see this in strong markets. I mean, that's just kind of what we're seeing. I mean, I know you're wearing a Frank Capillari hat there.
Shout out to Frank.
Yeah, he had a note this morning, talked about, new highs and advanced decline lines, a target on the S&P of 6,555. He's had that for a while. He's been bullish for a while. So the technicals have supported this move along with all that over-the-top negative sentiment. Like we talked last week, better earnings season and just better news out of the drama with Washington have all sparked this huge rally, which we'll get into a little more with some numbers in a second. What's your favorite
chart? Josh, I'll send you the picture of... Actually, Ryan, you did this tweet. You said a bunch of good charts at Frank Capillari's note this morning.
Yeah.
S&P 500 target of 6,555. And, I can't even pretend to see. He's got a couple of curves there. Can you explain that real quick? You know what I'm talking about. You tweeted that out, right? What is Frank talking about when he says, okay, there's a potential move to 65.55, which is about 10, 11% gain for the S&P 500 year to date?
That'd be pretty nice. Yeah, I mean, Frank's looking at like previous areas of resistance and then the weakness, like that size of the drop up to that new area of resistance was about 10 or 11%. And then if you were to break above it, I think we probably do, and Frank might agree there, but Frank's just doing what the charts tell him. Then you kind of add on what you just lost and add it on to the top, and that comes out. That's a targeted move, or a target is what we're looking at, and it's just more positives, I think, is what we'll say. Now, I was going to say, you're a Rocky 1 fan, Rocky 2, 3, 4, 5, 6, although 6 is called Rocky Balboa. Then, of course, we had Creed 1, 2, 3. So there's a lot of them out there. Let's break them all down. What's your favorite one?
The first one I ever saw was Rocky 4. So this was back in India in, goodness, 87, 80, somewhere around that time. I don't remember. Okay. So that was one of the first movies I had like an explicit memory of watching and enjoying, right? One of the I'm obviously not the first movie I ever saw, but it's the first one I remember seeing. I was like, oh, this rules, right? I mean, and since then, I obviously went back, watched everything. Rocky 1 is my favorite. I've seen that so many times. I've actually done the Philadelphia run, the steps, right?
Oh, yeah.
I run up the steps like at least 4 or 5 times, and it's always a blast. We should maybe do a live facts versus feelings there sometime.
Just us running up and down steps.
I don't know about running up and down steps. Maybe just on top of the steps or something. We'll do it. One of our videos.
Yes, no, that would be great.
But Rocky 1 is my favorite. What about you? Are you Rocky 3 or 4?
I'm four. I'm four all the way. When he takes down Captain Ivan Drago as a youngster back in the 80s, that was awesome. So yeah, but anyway, and this is somewhat, I'll just say it. My wife, literally, I wrote this blog about Sylvester Stallone yesterday. All right. And like 20 minutes later, she goes, "Oh my goodness." I go, "What's that?" She goes, "Sylvester Stallone just died." And I'm like, "What?" Like that, like a shot to my heart. And I was like, "Really?" And I'm Googling. I said, "Are you sure?" Because I don't see it. And it was Sly Stallone, the famous singer. So sorry to him and
Sly and his family.
Sly and the family. So thinking of the family Stone and everyone there. But I was like, okay, well, yeah. So that's kind of a shocker when you hear that. But all right. So with that, the Rocky Balboa market. It's strong. Let's talk a little bit about how strong this market has been. So
and global markets too, right?
Global market, but we'll do global in a second. Let me do the 2 months off the lows. And Josh, I know I sent this one to you somewhere. Here it is. All right. Nope, not that one. I've got welcome to the new bull market. We've got 2 things I wanted to talk about. Here we go. All right. So we'll share on the YouTube channel right now the S&P 500 best 2-month gains ever. Remember, we were down almost 19%, vicious bear market, down 10% in 2 days after Liberation Day. And that was on April 8th. And we just completed 2 months later. So we look at months like 21 trading days. So it's been 42 trading days just happened. S&P's up over 20%, Sonu, over those 2 months, 20.8% as we are sharing on the YouTube channel. Only 5 other times, going back to 1950, did we see a 20% gain in 2 months. They were February of 75, October of 82, December of 98, April of 2009, and then May of 2020. If you just think back, those weren't the worst times to be optimistic. Incredibly, 1 month later, 3 months later, 6 months later, and a year later, after every single instance, the S&P 500 was higher. A year later, you're talking up over 30% on average. We're not predicting a 30% gain the next year. I don't think we'd complain if it happened. But the reality is this blast of strength, this might sound familiar because I've said this for a while now, this blast of strength that we've seen off these lows is not consistent with a bear market rally, with a short covering rally, with any of the stuff that they're telling you out there. It is likely the sign of a new bullish phase. Trust us, that was not fun what we went through back in March and April, specifically the 10% drop after Liberation Day. But it looks like, we're back to your regularly scheduled bull market, which, Sonu, now you can chime in. It's a global phenomenon, right?
Yeah, and like they say, no pain, no gain.
Oh, boy. Right. Yeah, there's some pain this year. Yeah.
Speaking of Rocky Balboa there, but no, look, international markets, right? And it's a global bull market. You look at the S&P 500's up about just under 3%, let's say 3% year to date. But you look at developed markets, right? The MSCI EFA index, that's up 18%. MSCI EM index for emerging markets up 11%. So the US is lagging. And now, of course, if you pull back the horizon to the last 10 or 15 years, I mean, there's still a long way to go for international markets to catch up with the S&P 500. I should say the S&P 500 stands really tall here, right? As opposed to, like you take the Russell 2000 or small caps, it's a different picture. But still, 10 out of 15 major countries, and I group the European Union as one, the Euro area, they're up over 15%, Ryan, year to date. 12 of them are up over 10% year to date. Josh, I shared a chart with the table, we'll share it on the YouTube channel. But that just shows, and there's always a question about and we talked about this briefly last week too, is this just about the dollar going down? Now, historically, the dollar matters for international equity returns, especially for those of us who are US dollar-based investors, right? International equity returns have been very correlated to how the currency moves, dollar versus other currencies, over the last 24, 25 years. Ever since, think about after the euro came on in 99, China entered the WTO. Since then, we've seen this, right? International market excess returns, excess meaning excess over the S&P 500, usually negative when the dollar appreciates. So U.S. equities outperform when the dollar appreciates, which kind of makes sense because the dollar appreciates if U.S. growth expectations, profit growth expectations are much more than what you have outside the country. Now, when that reverses, when foreign growth expectations are higher than U.S. growth expectations, and I would argue that's kind of what we've seen this year. But remember, we saw that, interestingly enough, in 2017 as well. That was the first year of the first Trump presidency, right? And international markets outperformed. And historically, we've seen that. International markets outperform when the US dollar weakens. And this year, again, things have played out to form. But even if you look at local currency returns, right, take out the dollar effect, 9 out of 15 countries in the EU that I track, double-digit returns, even in local currency terms. Mexico is up 20%. Right. South Africa is up 22%. South Africa is a story about gold. Chile up 21%. Chile is probably a story of copper. But then, that tells you something about the global economy, despite all the tariff noise, that these countries are doing as well as they are.
Let me just chime in there. So Sri Lanka and Pakistan both hit all-time highs last week, right? I mean, Israel's flirting with all-time highs. I mean, there are countries you would probably not expect to be that strong if all you look at were the headlines.
Yet, and countries in outright war.
Yeah, well, exactly.
Or yet, close to it.
Well, I mean, I've used the stat before. I think we talked last week about the Dow being 126 years old. If we didn't, the Dow just had a birthday, 126. Oh, I'm sorry, 129. 129 years old, May 26. That's where I was getting the 26 from. The best year ever in the history of the Dow was in 1915, up, I think, either 82 or 86%, close enough for government work. But the best year ever, that was a little thing called World War I. All right, now, Stocks were down a ton in 2014. Or, I'm sorry, in 1914. Nonetheless, sometimes it doesn't make a lot of sense, but what does make sense, this is a global bull market with a lot of participation. One other thing, Sonu, on sectors, right? There's 11 S&P 500 sectors. 8 of them, at least this is as of Friday. So Monday was a pretty flat day, so pretty safe to say these are still pretty accurate. 8 of those sectors up on the year. 8 of those sectors outperforming the S&P 500 on the year. I mean, even tech has come back, right? So, I mean, this is, again, a broad-based rally, not just in the U.S. with sectors and even small caps. I mean, listen, small caps have been really frustrating. There are some signs small caps are starting to join the party all of a sudden, which is great. But the rest of the world is strong. Anything else you want to add on the global strength?
No, I think the big picture is, or big question is, does it continue? Yeah. And you think, okay, maybe there's some room for catch up, right? But the other thing is that, we could potentially see it continue. And from our perspective, in terms of, okay, at the end of the day, what does this mean for portfolios?
Yeah.
We, even before Liberation Day, we'd moved to, you and I talked about German fiscal policy, all of that. This is about 3 months ago now,
on this very podcast, you were all over it. Yeah.
And we'd already moved to a neutral position relative to our benchmarks and, U.S. versus international. And just on our equity piece of our portfolios, like 70% U.S., 30% international. And that's where our benchmark is. We don't feel the need to overweight international, right? Right. We don't think the U.S. is going to, U.S. exceptionalism is done or anything like that. But we still like the U.S., but we like other countries too, and we like to diversify, and that's where we are at now. And I think that's probably a reasonable spot. So if somebody asks me, like, oh, what do you think is going to outperform? My literal answer is, based on what we are doing in the portfolios, we don't know. And so we're neutral.
Yeah, but we are overweight stocks still in general, equities in general. Yes. So I believe it was March 3rd, right? We manage billions of dollars for our Carson partners and their clients. And on March 3rd, we took some risk down. We added some international exposure. We did some things. We kind of positioned for maybe some rocky seas. Now, we didn't think it'd be as rocky as it was in March and April, but that obviously worked out pretty well. And we're still in that camp. So you mentioned, look, I know the answer, but this is a good conversation. You said it's about 70-30. So 70% US, 30% international. Yep. What's that breakdown between developed international and EM and that 30 there?
In the 30, it's mostly like overweight. Normally, just think of the easy way to say like something like 20% developed, 10% EM. Rough heuristic, that's easy. We are overweight developed markets, especially Europe, and we are underweight emerging markets. Good question, though. Yes, and that's part of the story too. We like, especially with fiscal policy, things like that, things shifting, and it's really about expectations. It's not like if I had to say absolute level of growth, profit growth, I'd say, the U.S. is certainly going to be better than Europe, right? I mean, U.S. maybe let's say even this year, it could be 1.5%, 2%. Europe, maybe 1 to 1.5%. But 1 to 1.5% is a lot better than 0. 2% is worse than 3%, which is where we started the year. Like I said, it's all about expectations.
Yeah, no, you're right. And at the start of the year, I mean, listen, not too many people were expecting a lower dollar. And honest to goodness, not too many people were expecting Europe to do extremely well and kind of lead the rest of the globe. I mean, for 16 years, Europe has lagged the United States for the most part. So that's some interesting things that we're doing for our Carson partners and trying to help tell the story of what's happening, but also manage real money is what we do. And if you're interested in that and you're at a place that's not giving you the support you want, check us out, carsongroup.com. We'd love to talk because we're growing and there's lots of ways we can hopefully help you grow and help your clients as well. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback. That helps a lot with those algorithms that are out there. And then facts versus feelings, facts versus VS feelings. At carsongroup.com. I was going to say one more thing on equities. We just officially, Sonu, moved up 20%, as we talked about. I mentioned in 2 months we're up 20%, but then I took a look at all the previous, there's 17. And Josh will share this on the YouTube channel right now, the other chart I sent you. There have been 17 near bear markets or bear markets since World War II. 1 year after you finally bounce 20%, so again, we just bounced 20% off of those lows. And you start the clock once you hit 20% up. 1 year later, S&P's higher 16 out of 17 times, up an average of almost 19%. The one time that did not work was a 100-year pandemic. I mean, so assuming we can avoid something catastrophic like that again,
let's hope.
Let's hope. These are just little clues, right? I mean, I've said this before. People get all worked up. I share this stuff on social media. You share different things on social media. Don't ever take just one thing we say as the Bible, right? You have to do this. But when you stack all the stuff that I've been sharing, and so do you've been sharing, it continues to suggest the second half of this year is probably going to be pretty good. The U.S. might be playing catch up. Doesn't mean the rest of the globe still can't go higher. I think Germany we probably don't catch. What's Germany up? 20% for the year, 18%, something like that. We probably don't catch them. Maybe we go up a little bit more on a relative basis the rest of the year, but that's all right. But the reality is when you stack all these things on top of each other, I remember the Zweig breadth thrust. We kind of goofy and laughed at it. That was 6 weeks ago. I mean, what have stocks done the last 6 weeks, right? I mean, we have seen these signals, these clues. April 22nd, right? April 9th was that first big update where more than 89% of all the stocks and volume on the NYSE was higher. I said on this podcast, we'd like to see another big follow through sometime short. 9 days later, on April 22nd, we saw that second big follow through. More than 89% of stocks were up. 89% of volume was up. I took a look. I can't remember the exact details, but only a handful of times in history do you have 2 days that strong, that close to each other. Every time marked the lows, right? And we started talking about that back then on April 22nd. And now we've got more reason to think again. Now that we're up 20%, is it a new bull market? I'd say no. I think we've been in a bull market the whole time. It didn't feel like it. Trust me, it was volatile. But those are some things to think about. All right, Sonu, what I think
it's crazy
what do you want to talk about? Yeah.
I mean, since 2020, I mean, I think at the beginning of the year we shared this chart, but for the 5 years, 2020 through 2024, markets up close to 100%, especially after this year. Let's say it's about 100%. And we've had like 3 bear markets, or near bear if you include like. Yeah. And in some ways, I think like this has been one big grand bull market. Like if you're up 100% plus in about 5.5 years, I mean, surely that's a bull market, right? I mean, yes, we've had 2 bears in there, one near bear, but still, that was 2020, COVID, 2022 with the Fed, and now with tariffs. There's always something. But what's interesting, it always seems like something extraneous, external coming in, right? COVID came out of the blue. Then inflation didn't really come out of the blue, but the Fed, going from 0 to 5, I think hit people really hard.
Well, so the terrible war in Ukraine didn't help either, right? That spiked commodity prices, and that added to everything.
And then this year, tariffs, like you said at the beginning, and 145% tariffs were not on anybody's bingo card. So it was all these external forces. Somehow it's almost like this external force hits, and then the market sort of says, you know what? We freak out for a few days, then policymakers come in with support and help or whatever, right? And then that's why elevator down, elevator up. It's like a V-shaped recovery almost every time.
Yeah, no, that's true. And I mentioned before, the market actually peaked on February 19th, 2020. The market peaked on February 19th, 2025. But we had 2 bear markets, the one in 2020 and the one in 2022. And I looked at when do bear markets start, like that ultimate peak. We'd never seen 3 bear markets if we would have had a bear market this time. We've never seen 3 bear markets that close to each other. All right. Usually they space out a little bit. Yeah. We kind of talked about that. I mentioned at the time, then we had Liberation Day. I'm thinking, well, I guess throw that out the window. We might be down 20, but we obviously technically avoided it. But again, it'd be very rare. We came into this year talking about some of these concepts. Like it'd be very rare to see a bear market like I just laid out. But you know what? The third year of new bull markets tend to be volatile, tend to be choppy. Early in a post-election years, usually not that great. Early after a 20% gains, usually not that great. The first quarter, last 20 years has by far been the worst quarter. You stack all that on top of each other, we expected to see some volatility. That's why on March 3rd, we diversified and got out of extremely overweight equities, took that down a little bit, added some international exposure, kind of expected some rocky seas, and we got them. And I'm talking like a pirate again. Rocky seas. Look at that. It's subconscious.
You just need to pull your cutlass out now.
Yeah, exactly. Now I know what it is. I need to get one of those. I need to get a cutlass. I need to get an extender for my Ethernet cord. I know that much. I need to get a cutlass. I'm going on Amazon later since we hang up. All right. Well, we are. I think we did pretty good talking about equities. Want to talk about the economy for about 10 minutes?
Yeah. We can do payrolls. We can talk about housing a little bit because I think it flows through to what is. What do we see with payrolls? How does that impact policy? In this case, Fed policy. And, what's going on in housing is, I think, directly related to interest rates, right? So, with respect to payrolls, look, I think we came into this week before, this is last week, right? Last Friday is when we got payrolls.
Yeah.
Almost every day we were kind of getting like sketchy economic data. Not terrible, but it was sketchy, right? Like it was around, like we got ISM manufacturing data that was below 50, which means our manufacturing sector is contracting again. And then we got the services PMI, which also said, okay, the service sector is in contraction. I think there's a tale of two pieces there because services also has things like construction, right? In addition to restaurants and, bars and retail and all of that. That side of the economy is, I think, doing fine. It's the, construction and manufacturing, that side of the economy is, I think, struggling. Again, a rate story. Then we got auto sales on the the beginning of the month. Auto sales fell 9% in May. So that's going to hit, I think next week we get retail sales. But that's going to be, negative, or it's not going to be in great shape because auto sales fell, right? We got ADP, private payrolls. That was on the low side. So all of this stuff was going on. And then we come into Friday, I think expectations were for like, okay, payroll's going to increase by 126,000, but there's always like a whisper number, right? And, Libby Cantrell talks about this when she talks about politics. There's always a whisper number. I think the whisper number is like, this payroll report could be really bad, especially after the tariffs. And the economy created 139,000 jobs in May. The unemployment rate was unchanged at 4.2%. Boom, market is off to the races. I think it was just a relief. And Friday was a big update. I think the S&P 500 is up more than 1% or something like that.
Yeah, and again, making up the losses the day before, like we talked about with Rocky a little bit ago. I saw it's 53 consecutive weeks now we've actually seen payroll growth. And you pointed this out, but the unemployment rate went from 4.187% to 4.244%. So it's rounding still a 4.2. So let's wrap this first part up. It came in better than we thought.
Yeah.
Market bounce. But then when you looked under the surface, Sonu, there are some legit concerns, I think, right?
And these are slow burning. It's like the slow burn that's happening under the hood. I'll talk about housing also. It's a like slow burn.
The old frog in the hot water, right? Or the boiling water. He doesn't know to jump out until it's way too late. Are we the frog? Are we the frog right here?
I don't know. Hopefully not. And it's not too late. It's far from too late. This is just the beginning, right? But there is trouble under the hood. You look at payrolls. Yes, 139,000 is great, but we usually almost always get revisions. And lately, those revisions have been negative in a big way. Payrolls for March and April are revised down by a net 95,000. Right, so March is revised from 185,000 to 120,000, so that's 65,000 jobs lower. By the way, when it was first reported, first week of April, March, they said 228,000 jobs created. Now we're down to 120. April was revised from 177 to 147,000, right? And that brings the 3-month average to 135,000 year to date over 5 months. The economy's created about 120,000 jobs on average per month. 619,000 jobs. Back in December, the 3-month average is running above 200,000. So no question, this is a slowdown, right?
Yep.
But then the other side of it is immigration has completely collapsed. And if immigration's collapsed, the economy doesn't need a lot of jobs to keep up with population growth. Maybe it needs only 80 to 100,000. So even if we are at 120,000 jobs per month that the economy is creating, that's okay, right? The problem is, remember, this is coming from surveys, right? The 90% confidence interval for the survey is about plus minus 136,000. So now we are below that. And I'm thinking, wait a minute, could job growth be actually negative once revisions are done and all of that? Maybe. And that's what, and then you talk about the unemployment rate. January unemployment rate is 4%. February, 4.1. March, 4.15. It was rounded to 4.2. April, 4.19%. It was rounded to 4.2. May, 4.24. It was rounded to 4.2. You get the picture, right?
Yes.
4.24% unemployment rate in May. This is not a big increase, and things could shift the other way, right? But this is the highest unemployment rate since October of 2021. So, there's some things happening under the hood, and we can talk about job composition. But quick thoughts from you. What do you make of this?
No, I mean, I just do whatever you tell me. But no, it does.
I don't know if that's a good thing.
I don't know either. But no, it does feel like under the surface, it is some weakening, right? I mean, the one that got me again, you mentioned, but March was originally 228,000. Now it's 120,000.
Yeah.
That's just 2 months ago. That's a pretty big revision.
in pretty quick time too, right?
So pretty quick time.
So you think about the 139, could they revise it down to like, let's say 20 or 30,000? Maybe. I mean, I don't know.
You know, our good friend Neil Dutta over at RenMac, I don't think we can have a podcast without citing Neil, so we're just going to keep this rolling. By the way, next week, we'll just give it away now amongst friends and family. Sam Rowe is going to join us in next week's Facts versus Feelings. Sam's awesome. He's a repeat offender. This might be his third time. We'll have to look that up.
I think fourth or something.
Third or fourth. I don't know. I can't believe he wants to keep coming back.
It's fun having him.
Oh, Sam's awesome. So anyway, we'll talk with Sam next week. But Neil, quote unquote, just straight from his note, the Fed is whistling past the graveyard. I mean, when one of the smartest guys we know is talking like that, I mean, what's your take when he says, what does he mean when he says whistling past the graveyard specifically? But he wrote it about kind of, the jobs data. What are you thinking there?
Policy is too tight and the labor market is weakening, which means policy is getting tighter.
There you go. Period. Pretty simple. Yeah, pretty simple, right? I mean, yeah. Okay. That's it. Well, yeah, so that's what Neil said. I had one other thing I wanted to point out. Where is it here? A record 159.6 million people employed in the United States. That is 7.3 million more than the peak right before COVID. So, our economy's bigger and there are a lot of people with jobs, but the labor market is slowing. I mean, listen, JOLTS came out. I'll just chime this in. The Challenger Gray layoffs, and I get it's volatile. I mean, but listen, it actually was down. Layoffs are down 11% in May, and it's a 4-month low. So, I guess that's maybe a positive. I don't know. I mean, but again, it's like 80% higher than it was a year ago, though. So layoffs are a lot higher, but they're a little bit lower than recently. So you can spend that however you want to spend it. Yeah.
No, I think that, again, it's certain areas, right? We have this bifurcated economy. You have let's call it interest rate sensitive areas of the economy, which is like manufacturing, housing, things like that are struggling. And even technology to an extent, and I'm not convinced it's the AI story. Like, again, coming to job composition, right? 63% of that 139,000 jobs created in May were in non-cyclical areas. Okay. Healthcare, social assistance, private education. This is not sectors that's impacted by high interest rates, not directly by any chance, right? And then employment in cyclical areas, you're looking at professional business services, information, which includes a lot of tech jobs, manufacturing, that fell by 24,000, right? Now, leisure and hospitality jobs rose by 48,000. Again, these aren't very high-paying jobs, but it tells you service sector activity, like restaurant spending, travel, all of that is okay, right? But this theme that we've seen where job growth is dominated by non-cyclical areas of the market, including of the economy, including government, by the way, we've seen that over the past year. And even year to date, over the first 5 months of this year, the economy, like I said, created 619,000 jobs. 61% of that, 379,000, in healthcare, social assistance, private education. Another 5%, 33,000 was in government, right? So you're looking at 2/3 of jobs are created in just these, non-cyclical areas of the economy. And that's really skewed. That's not what you would see. That's not what you want to see if the economy is firing on all cylinders. I think big picture is, look, the cyclical areas of the economy are weak. And we've got the tariff uncertainty and we've got high interest rates. And that gets to what Neil was saying. And I agree with him. I think the Fed is whistling past the graveyard. Nice way to put it.
Well, we were saying start of the year, the Fed probably should have been cutting. They waited. Remember, they did a 50 basis point cut on, ironically, Talk Like a Pirate Day, September 19th last year. The only reason I know that is because it's my son's birthday. But the reality is they probably should have done 25 basis points before that. We did get some news, though. The New York Fed came out just yesterday with a survey that showed the 5th largest 1-month drop in inflation expectations going out 1 year from 3.6% to 3.2%. The Fed has said they want to see inflation expectations coming back down to earth before they can comfortably cut. So that's potentially one positive thing. And one other thing I want to point out, because I thought this was interesting. Citigroup came into the year with a 6,500 target. They lowered it to 5,800 right at the April lows, and they just upped it to 6,300 right now. Now, they're not the only ones doing this, so they're not the only ones doing this. But we're seeing a lot of Wall Street that's doing this, and now they're getting a little more bullish. How about that?
As go tariffs, so goes targets, maybe. But
yes.
Look, I think at the end of the day, and this one, like you said, we are overweight equities, right? But that doesn't mean we are not seeing, like I said, the slow burn happening underneath the economy, areas that should be firing well, but they're not. And housing is a good example of this. And you and I have talked about consumer balance sheets. By the way, did you know that credit card debt went down last quarter? I mean, there were no headlines around that. Usually it's always like, oh, credit card debt is expanding. We didn't see that, right? But you and I talk about household balance sheets all the time. What's a big part of household balance sheet? Home values. And one thing that's happening is we're starting to see home prices are easing. In some of the cities tracked by the Case-Shiller index, prices were down. I think out of the top 20 cities, prices fell in 14 of them in March, right? And this is delayed data. So I think and it's averaged over 3 months, things like that. I mean, Tampa is seeing a negative year-over-year home price drop of about negative 2%. San Francisco home prices are off 6% from their peak, right? And, the overall national index, the Case-Shiller National Home Price Index, fell 0.3% in March. But that's the thing, right? If home prices come down, suddenly, first of all, because of high interest rates, people couldn't access home equity already. And now you think, wait a minute, if home equity starts to pull down because home prices are going up, then we have a problem on our hands. I'm not saying the problem is here, but this could be a big problem if it continues by the end of this year, if not the beginning of next year. So that's something I'm watching for. Like I said, it's a slow burn. You'll see where it goes.
Well said there. I think might be time to wrap it up. I think we've covered a lot of bases here. There's a lot of things going on out there. The reality, are we slowing? Yes, we're slowing. Are we headed straight for a recession? We'd say still not. Remember, we just had a really solid earnings season. My son, Sebastian, was in London for the past week, and he didn't eat much the first 2 days because he didn't really like the food, I guess.
Is he part of the negotiating team?
Yeah, he's over there in London. I told him to go find the Chinese and the U.S. And get this deal done. But then all of a sudden, he uses green light, right? So I kind of know when he spends money and what he buys it on. He's been buying Five Guys burgers like twice a day for the last 3 or 4 days. They apparently found a Five Guys, so he's trying to help. I guess it's a U.S. economy, although he's spending it over there. But nonetheless, he's trying to help the global economy, I guess, by eating a bunch of hamburgers.
You know what that means? If he's spending, as an American citizen, since he traveled abroad and he's spending it there, that counts as an import. So don't tell President Trump your son's contributing to the trade deficit.
Oh my goodness! With hamburgers, French fries, and milkshakes. That's what a isn't that the most American way ever to contribute to anything? To do it with burgers, fries, and shakes. That's funny. All right. Well, listen, this was a lot of fun. Thanks to all the listeners out there. We've hit a lot of good numbers lately. We really, truly appreciate it. Again, this was episode 139, Bromance Interrupted with Ryan and Sonu. And again, next week will be a really good one. We're joined by our good friend Sam Rowe. So with all of that, everyone, enjoy. It's summertime. Keep this market going. Get some vacations out there. Enjoy the sun, and we'll see everybody next week. Take care. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.